I was seeing how these roll-ups uh, could really translate into multiple expansion. And multiple expansion, of course, is the idea that if you buy small things, you're likely going to pay a relatively small multiple of cash flow from a valuation perspective. If I buy $1 million EBITDA business as an example, I can buy that at 3 or 4 times EBITDA. If that asset is worth $5 million of EBITDA, I'm going to have to pay up for it. I'm going to have to pay 7 times. If it's 10 million, I might have to pay 10 times or 12 times, depending on how quickly it's growing and depending on what industry that it's in. And I was really enamored by this idea of multiple expansion. Warren Buffett often says that compounding is the eighth wonder of the world. I'm pretty certain that multiple expansion is actually the eighth wonder of the world. And because it just has such a significant impact to juicing your equity account when you go to sell the platform.
So you have a really interesting background. You were a lawyer for, it seems like, almost 2 decades at Kirkland and Ellis.
Yes,
Um,
yes.
you worked on some really big deals there, and then you moved way down market and you bought a series of software businesses that you rolled up with a partner, sold to Alpine, I think very successfully. Now you're running Funded Ventures, which seems to partner with searchers on acquisitions. How did you decide that? Well, first, I'd say you're by far the most entrepreneurial lawyer I've ever talked to. Um, and how did you move from the big deals the really like focusing on the big deals to moving way down market?
So I was seeing this up close and I was sort of scratching my head and saying, like, there's something really interesting here. I'd love to figure out a way to capture some of that value as a principal, not as a deal lawyer, but actually get more involved in one of these roll-ups as a principal. We live in this neat town north of Chicago where a lot of the people in our community are doing cool things. They're in private equity or venture capital or they're operators and stuff like that. And I'd be having these conversations, trying to like explain to them what I was seeing as a deal lawyer and understand what they were doing as private equity investment professionals or as operators building their own small businesses. And as luck would have it, there are a few folks in our community. In one case, one of the guys actually teaches the search fund an ETA course at the University of Chicago. And I was talking to these guys and I was saying, like, listen, I've been doing this a long time. I'm thinking about leaving the law firm and, trying to build something. But like, I'm trying to figure out if it's a good idea. Here's sort of what I'm seeing. Help me understand what I'm seeing in the context of what you do every day. And all of these guys were shaking me loose and they were saying, like, yes, take the experience that you've been seeing as a passive limited partner in these funds or as a deal lawyer, but don't try to go out and raise a 400 or $500 million fund. Take it down market because that's what these guys were doing.
If you run a holding company or business with multiple entities, you should definitely listen to this. At Enduring Ventures, we have over 50 bank accounts across our different portfolio companies. Our director of finance, Nick, spends every morning going through those accounts one by one and making sure that the cash balance is where he expects it to be. This used to take him an hour or so every single day. There really wasn't an easier way to do it. Then a friend of mine introduced me to Vesto. Vesto makes it easy to connect all of your bank accounts into a simple dashboard. So you get real-time balances, transactions, and cash flow monitoring all in one place with just one login. So Nick got to go from checking 50 different accounts to just checking one account and one dashboard every single day. A job that used to take Nick almost an hour every day now takes him just a couple minutes or less. If you're managing multiple bank accounts, Vesto is a no-brainer. Go to vesto.com, tell them that Sieva sent you, and you'll get to speak directly to the founder, Ben.
I really wanted to find a partner. I wanted to do this while staying at my law firm, but having somebody who I could rely on who could run this business day to day. And as luck would have it, through a lot of coffees and conversations, I met somebody who had previously bootstrapped a small SaaS company. He had sold it. When he sold it, he made, pretty decent money, not enough to retire and live on the beach. And we had a lot of conversations externally, sort of in the community to sort of develop our thesis. And after about 6 months, we decided to go ahead and do this together. And we had a very specific thesis. And the thesis was, in talking to a bunch of bootstrapped technical founders of these small SaaS companies, we decided that we wanted to focus on SaaS. we started to identify this theme that we heard over and over and over again. And that was there are a lot of bootstrapped SaaS founders who have been able to grow their business to $500,000 to $2 million of top line revenue. And they're running a high quality business. They don't have a lot of churn. They've got pretty good margins. So these are good, sticky little businesses. But what we found as we sort of dug into the situation a little bit further is that a lot of these businesses, they actually weren't growing much. And it wasn't a matter of them not growing much because they weren't high quality. Again, the fact that they had gotten to $500,000 to $2 million of revenue with low churn, that was a clear demonstration that they had great product market fit. They had a very sticky customer. They were clearly delivering a high value proposition into the market, a high valued proposition. But what we learned as we continued to dig deeper was that there was almost universally something that had happened in their life. Maybe they got married and they wanted to buy a house. Maybe they started to grow their family. Maybe they wanted to buy a house. Some of these guys want to continue to build new things. They have new ideas. They're serial founders. So one of these guys wanted to go out and create a new app. But something happens oftentimes in their life. And the net result of that is instead of taking all of this rich cash flow from their business and reinvesting in commercial execution and continuing to accelerate the growth trajectory of their business, they decide to start taking a lot of the excess cash flow out and they start running their business like an annuity. And the problem is it's totally natural for them to make that decision. You and I would make that decision if we needed to take care of things at home. But in SaaS, there's what's called the rule of 40. Sometimes people call it the rule of 50. And basically what it says is if you're a software company, if you're a SaaS company, if you're a B2B enterprise SaaS company, and you want to try to figure out, well, what's the valuation of a business like that? The rule of 40 basically says that two things matter. What is your organic growth rate and what are your margins? And if both of those things are high, you add them together, and if they're in excess of 40%, if both of those metrics are high, you're a high quality and high valuation SaaS company. You might be worth 5 times revenue, 6 times revenue, not even revenue, 7 times revenue, an infinite multiple of revenue as we see sometimes. But the dirty little secret is if you're low growth, even if you're high quality, if you're low growth, if you're only growing at 1 to 3 or 4% a year, you're actually not worth much. You're only worth 1 to 2 times revenue. And so our strategy was to find a highly fragmented vertical. We ended up focusing on the MarTech space, tools that are used for SEO marketing. And the thesis was we wanted to go out, we wanted to start buying up businesses, competitors in that space that were low growth, low churn, low growth. We wanted to buy them from an entry multiple of 1 to 2 times revenue. We wanted to go ahead and bolt them together and create this platform. And then what we wanted to do was flip the script on what the seller had done. We wanted to actually overinvest into sales and marketing. We wanted to get that organic growth rate from 1 to 3% up to like 20 or 25%. And our thesis was if we could do that, what would ultimately happen is that when we went to sell the platform, now at a much larger size, hopefully growing at 25 or 30%, we would be able to sell that platform more at a market normalized multiple basis, 5 times revenue, 6 times revenue, 7 times revenue. And as you know, when you're able to do that, that's what creates that significant multiple expansion. That's what creates that opportunity to have, all of the variance between your entry multiple and your exit multiple really sort of accrue to your equity account, and it can really juice your returns. And so that's what we did in around 2015, 2016. We bought 3 businesses. We used a 7A loan for the first business. We used a lot of earnouts.
What was the first business?
A lot of seller financing. What's that?
What was the first business? Was that Authority Labs?
Yeah, it was called SERPS.
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 Got it. What was the revenue of that business when you guys bought it?
Yeah, it was pretty small. It was probably doing about $1 million or so of ARR. And then we got to work. We put these businesses together. We're very capital efficient, a lot of earnouts, a lot of seller financing. And then, then the fun began. I mean, I love to go out and market and sell. And the beauty about this business is if you sell anything online, if you have an e-commerce marketing manager, if you've got a website, if you're a search agency that advises e-commerce companies, you need a tool like ours. Basically, what our tool did was that it allowed you as a merchant to understand how you were performing from an organic search results perspective. And so just to unpack that a little bit, if I'm Foot Locker and a new pair of Air Jordans drops, you know, I want to see when a kid types in new Air Jordans into Google, I want to see where I rank on the Google organic search results. If I'm in the first spot or the second spot or the third spot, science shows that there's a high likelihood that the consumer is going to buy from me at my website. But if I'm on the second page or the third page, they're probably not going to buy from me. And as you know, there are a lot of things that I can do to my web page to try to improve my position on the Google organic search results. And so all of these businesses and these search agencies need this tool to be able to first understand how they're ranking across a bunch of different search terms, but then also to see as they're making these changes to their website, how it's improving their position on Google search results. So that was a lot of fun for me because if you tell me like, listen, everybody needs this tool, I'm on it, right? I am so excited to go
I
out
think I was a
and reach
customer.
out to,
I ran like a big SEO business as my first company. So I
yeah,
remember
there you
service.
go. And we sold through, we had a white label solution. We had a solution that was more of a self-service customer acquisition model solution. And we just had a lot of fun going out there and trying to convince everybody in the world to buy this, what's a relative commodity from us, not from one of our competitors.
And and ZoomRank and Authority Labs, were they about the same size, about 1 million revenue each?
Authority Labs was a lot larger. It was a multiple of that. So we ended up buying Authority Labs about 18 months into our journey. So that's sort of what allowed us to accelerate getting to scale because we were able to bolt on that business and it was much more mature than the first two
And
deals.
how did you guys structure the purchase for that one? Were you able to still use your SBA capacity for it?
Really interesting. So I want to be very careful about this because I know this is very, very hard. We actually did that acquisition all in a seller note.
Wow.
So we were able to buy that business all in a seller note. Now, it required 6 months of back and forth with the seller. He ended up pushing us on the purchase price. We ended up paying a lot more for that asset than we had, sort of started around the negotiation. There were all sorts of conversations, as you might imagine, around credit support. I don't recall exactly how many years uh, we were supposed to pay out that seller note. It was a number of years, let's call it 5 years or so. The seller was a technical founder who had created other businesses. He also had some shareholders. And so he was probably only spending 8 or 10 hours a week on this business. And so you have to have sort of the right confluence of variables and attributes to make a deal like that work for a particular seller. But in his case, it worked. It was sort of interesting because, the base case was that he would have gotten paid out a lot of money over, let's call it 5 years or so. We ended up selling the platform about 12 months after we did that deal. And that actually accelerated the full repayment of his note. Instead of getting paid across 5 years, he got paid all of it about 12 months later. So listen, at the end of the day, everybody sort of won. I mean, that's always our objective. This is why, even being a dealer is a lot more fun than being a litigator because there really is an opportunity sometimes for everybody to sort of
Yep.
win. But that was an important acquisition because it allowed us to much more quickly sort of get to scale.
I'm sure there's a lot of people listening who are going to be curious. How do you get a business on a 100% seller note? I think you made some references to how that occurred here. Um, how did this happen? Like, what was the motivation of the seller? Somebody listening to this would say, well, why wouldn't they just hold out and maybe sell it to somebody else, or why wouldn't they just keep running it 10 hours a week? That sounds like not.
These are very fair
Yeah.
questions. So first, like I want to preface by saying, like, it doesn't happen every day. And I know sometimes you listen to podcasts and it seems like it happens every day, but it doesn't. So yeah, so there were a few of the other aspects to that were, this is back in like 2016-ish, 2017. Acquire.com wasn't around. There just wasn't, this doesn't seem like that long ago, but the market has actually gotten a lot more efficient even over the past 7 or 8 years. And so in his situation, I don't know that there was an efficient market to take that asset to market with. I mean, he was only probably working in the business 10 hours a week. Private equity probably didn't have an asset like that. And so, it wasn't going to be the sort of situation where a strategic could come in and just take that asset and bolt it on, at least not sophisticated equity. And so, the market wasn't efficient. There wasn't a natural buyer universe. So for all these reasons, I think, and because he was only spending 10 hours a week, I think his perception of the value was probably relatively low. I think for his third party equity investors, this was all option value. I think they had like helped him develop his initial website and do some of the back end. They may have invested a month or two into this entire company, the third party investors from several years ago. And so, again, everything's about human behavior. I think that this was all gravy and option value, which isn't to say that like he would have taken anything for it. He didn't. It took us 6 months of very aggressive negotiation, starts and stops. But eventually, I think that he probably, had other businesses in motion. This was like all gravy to him. And at some point in the process, he was probably willing to take a little bit of risk on the note. There are some things that I always feel like are sleeves off your vest when you structure a deal like that. Like, I'm always happy to pledge the equity in the business back to the seller, right? Like, the idea being, like, listen, we'll go ahead and come up with a payment schedule that you like. You know, I'm happy to put in place some covenants so that there's some cash in an account somewhere. I can make representations once a year that we have that cash in that account to continue to pay you over the next year for your principal or your interest. There are a bunch of things that we can do. I'm happy to pledge the equity back to you. So if I fail to make a payment and I don't remedy the situation, you can keep all the cash that we've given you on this note and you can basically claw back the business, right? So there are some things that you can do to try to give that seller some comfort, but you're never going to be able to fully solve all of their issues. And so it's really a matter of whether you can sort of give them enough and whether you can give them enough of a premium, maybe not relative to the market, but enough premium relative to what they have in their head around sort of their value of the business to at least make it sufficiently attractive for them to be willing to have a conversation. I will tell you though, like I've tried to use that same playbook 100 times since then. Maybe I've gotten traction a few times, but like that was a very unusual situation. And it's always important to me to sort of reflect upon that. Because if that's the only sort of deal that I try to do on a go forward basis, I wouldn't transact very much.
Yeah, it sounds like catching lightning in the bottle. I've certainly heard about it before. We've actually done it twice, not 100%, but 90% seller notes. So it's possible there's reasons that sellers do it.
It also helps too. Yeah, in these holdco structures, if you have other assets, we had already done two other deals. I think the second deal we did outside the SBA, so we could encumber that asset too. So like, from a credit support perspective, if you've got a holdco, if you've got other assets that aren't encumbered or that you have the ability to lean up, again, at some point, you might be able to provide enough credit support to be able to sort of get that seller comfortable that they have, enough credit support to look to if you fail to make a payment or if you default on your obligations. After we did the third deal, a couple of things happened. One, we had a significant win from an organic growth perspective. I had a good friend who actually owned a really large search agency, and we were able to do a significant deal with her. A significant 6-figure deal which ran across multiple years, um, in a contract. So it would be respected by a buyer. And that had a significant impact on our overall base of revenue. It really allowed us, between that deal and just our normal sales efforts, to really get to a place where we were now growing this business, you know, well north of 25 or 30% a year, which is really sort of where we felt like we needed to get. We didn't think we'd get there for a number of years, but that was ultimately sort of where we wanted to get this platform to. The other thing that happened, though, was every time we did a deal, we issued a press release. And we did it for a couple of reasons. One, we issued a press release for the first deal. Somebody saw that and reached out to us, and that formed the basis for doing that second deal. The other reason that we did it was from a commercial facing perspective. I really enjoyed continuing to tell my network what we were doing. It really allowed my network to be able to see what we were doing and send me emails and send us emails from time to time and say, oh, you should talk to that guy over there or that woman over there. They're in this space as well. And so what ended up happening was after we did this third deal, we really put our head down. We were really focused on standing up a sales and marketing team. We had just done a lot of work from a back end perspective to try to get our tech stack uniform across the three deals. And then we had a significant roadmap on the front end to try to figure out how we were going to harmonize these brands, some things that we were going to try to do from a product offering perspective. So we got to work on that. We landed that large deal, and then we got an inbound. And Alpine said, listen, we saw the press release for your latest deal. We're putting about $400 million into this new arm called Alpine Software Group, which was actually, it looked and felt like a bunch of platforms, just like the platform that we were trying to build here. And they said, one of the platforms that we want to develop is in the MarTech space. We've taken a look at what you guys are doing. We think it would be, a good anchor for what we want to build in that space. Do you have any interest in selling? And at the time, we felt like, we weren't patting ourselves on the back. We felt like we had good momentum. We felt like we were starting to see the promise of our thesis begin to play out, but we still felt like we had another 2 or 3 years of doing some additional deals and really seeing our product roadmap through. But it was a good offer. And so we started to have a conversation. And after a month, we were able to negotiate a deal that we decided to take. And at the time, Alpine, we didn't know this, but Alpine was running like 7 deals, including for our 3 companies, simultaneously while they worked to sort of set up this ASG arm. So it was a very frenetic time. It was like at the end of 2017. So we ended up selling the business to Alpine. We hung around for a year. We had an earnout that came due about 12 months later. The earnout was all about further growing the business from an organic growth perspective. So it looked at our ARR at the closing, and then it looked at an ARR that was probably somewhere around 15% higher. And we had 12 months to help the business get to that higher level of ARR. So we were very incentivized. I think about 10% of our purchase price was in an escrow to satisfy potential indemnification claims, and about 10% was in an escrow with respect to this earnout. So 20%, it adds up. It was a meaningful amount of money. My partner and I really got to work. We were very focused on doing whatever we could to hit the earnout. And it was all or nothing. It wasn't staged. It was all or nothing. And to be honest, like often happens with these small deals, the business actually took a step back. I think the business lost a customer within the first month or two. And that just happens sometimes. Alpine was doing all of the right things to look at the team, to look at the product roadmap, to look at the tech stack. And they were making decisions, really taking a longer term view, where for us, we were just trying to keep the train on the tracks and moving forward. And so we were probably 2 or 3 months into that earnout period post-closing, and we were really far behind. And to Alpine's credit, we reached out to them. They said, we said, we're really interested in trying to do whatever we can to try to hit this earnout. And they said, well, listen, come up with a plan. They said, we're willing to even put a few dollars in. We're willing to pull somebody from one of our other teams to support you guys. You let us know what we can do to partner with you to give you the best shot of hitting that earnout. And we ended up hitting the earnout, like no joke, 2 or 3 weeks before the end of the anniversary of the closing date when the earnout came due. We may have even extended it by a month, but Alpine, to their credit, really did everything and more to give us the best shot at being able to sort of hit that earnout. And that was a very satisfying feeling. And so after we finished the earnout, I had continued to stay at my law firm, but I started to really throttle back for a lot of reasons. I mean, being a lawyer is a lot of fun. Doing deals is a lot of fun. And so I started to throttle back my practice. Then COVID hit. I started, though, to spend a lot more of my time sort of in this subscale end of the market. As you mentioned, I had taught a class on private equity at Washington University in St. Louis at their law school, where I had gone to school. They asked me to start teaching the ET and search fund class to their MBA students at their business school. I now also will teach that class actually next week. I'll start teaching that class at the University of North Carolina. And I really started to just ramp up my presence in this space, both through teaching. I ended up hiring a few of my former students who are out in the market today, running full-time searches to buy their own small businesses. I started to speak at a lot of the search fund conferences and do some writing in this space. And, I'm just having a lot of fun. Last month, I formally departed from my law firm. And, now as I'm looking forward to the next year and beyond, I'm really excited about, having the opportunity to now use all of my energy to sort of figure out what my contribution is going to be into this space, over the next 10 years or so.
Fascinating. And I want to talk a little bit more about the searcher aspect of this. But I had a quick question on your sale process. So a lot of sales that I've encountered have a earnout aspect. Maybe they have a seller note, maybe they have an earnout. Is there anything that you learned in hindsight as a seller about how to properly structure the earnout to really protect yourself? It sounds like Alpine was a great partner, maybe even gave you guys an extension there, worked with you guys on a plan. But is there anything that a seller should be thinking about as they go into it?
Absolutely, they should. Don't do it. No, but there is some truth to that too. So I dealt with earnouts all the time upmarket, right? So let's just talk about, like, why does an earnout occur, right? Because it usually pops up under pretty similar circumstances. And these were the circumstances in our situation. Buyer and a seller start negotiating deal terms, and they get really close. And everything else is sort of, we've got basic alignment, but there's just this matter of purchase price. And let's say there's a gap of 10%, 20%. And, there's fatigue. There's deal fatigue over that negotiation. And one of the sides, the buyer or the seller, says, hey, this is easy. Let's just plug it with an earnout, right? At the last minute in the negotiation, let's just plug it with an earnout. And oftentimes what happens in that situation is then one of the principals will go to their lawyers and just say, listen, this has been a hard negotiation, a long negotiation. We finally got there. We ended up just plugging it with an earnout. And, here's sort of how the earnout got set up. And because of this dynamic, the last minute nature, the desire to just jam it to sort of continue to move forward in the process, it often also doesn't get papered very well by the lawyers. There's not a desire to get into the minutia. The buyer and the seller might just say, like, listen, we sort of agreed it's about hitting this sales mark, or it's about hitting this EBITDA mark, or whatever. Like, that's it. And so the contract will say, if on the first anniversary of the closing, EBITDA is X, then, the seller gets
EBITDA
Y.
is a nightmare calculation. You say that and I'm like, oh, there's 1,000
There you
versions of
go.
EBITDA.
There are a number of issues with what I just described to you. How do you define the relevant threshold? What are the covenants around what the buyer needs to do to actually enable that threshold to get hit? And we experienced that live. Alpine's incredibly sophisticated. We use sophisticated counsel. This is just inevitable in earnouts, and you see it. If you look at the research, even for upmarket private equity, a tremendous percentage of earnouts result in a dispute because of the dynamic around how earnouts like come into the deal and how they get drafted by the lawyers. There's just no incentive to slow the entire process down to negotiate the second or the third level, because if you did that, the deal would likely fall apart. And so everyone just says, we'll figure it out later. And of course, that often leads to some disputes where very credibly, both of the sides might say, this was just not how I had it in my brain when we were negotiating out or for what we agreed to. And I don't think either side is lying. It's just that, earnouts can be complex for the reasons you just mentioned. And there's just not a desire to go to that level of specificity, to pay the lawyers to get into that level of specificity when the deal gets signed and when the closing takes place. It's only when you actually go to try to achieve the earnout does some of these second order questions start to pop up. And so I would say, though, like, there's a commercial aspect to this, which is like, you do want the process moving forward. And while I hear there are exceptions, like usually the earnout is not 70% of the deal value. And so I would also say, like, just recognize that if you use an earnout as a solve to sort of plug in the hole on valuation, and you're all just going to sort of let that lie and deal with it at a date down the road, just realize that, like, the reality of the situation is that you might have a dispute over it. And when you get there, just don't be surprised. You might have to bring in the lawyers. Hopefully you can sit down at the table and sort of work it out. But I do think that it's important for people to realize that there's no free lunch. Don't plug it in and think like, all right, everything's great. It might be great to get the deal done. And maybe that's your first order objective, but there's a lot of residual risk to sort of going down that path that you should just be aware of.
So maybe some takeaways from what I'm hearing. One, if you can avoid it, avoid it. If not, if you need to use it to bridge the gap, try to use terms that are less ambiguous. For example, EBITDA, highly ambiguous. Use terms that are not like EBITDA and try to define them, try to define formulas of how it's going to get done, but also perhaps prepare for a little bit of a wrestling in the mud when it's all said and done. Is that fair?
Exactly right. And the last point is just the standard of effort, right? When you negotiate this deal as the seller, you've had full control over this business. Once you hand it off to the buyer, like, they're operating the business. The ability to hit EBIT. I mean, we were very involved in our earnout. Sometimes that's not the case, but you just have to remember that, like, the buyer is going to operate this business different than the way that you did. And so incorporating standards of efforts, I think is really, really important. What are the things that the buyer is agreeing to do? Are they, if it's an earnout around top line or EBITDA, are they agreeing to put somebody on the team focused on this? Are they willing to put in some marketing dollars? What are the things that they're agreeing to try to get you as the seller the best opportunity to sort of hit the thresholds for the earnout?
Okay. That's great to know. And then for those listening, they might be curious, like, why does multiple expansion happen? What's the simplest way to explain that? Why is a business with 1 million of revenue trade for 2 times total price, and a business with 10 million of revenue might trade for 4 times, 5 times, 6 times?
Yeah, I think there are two main reasons. So first, like, small businesses are hard, right? I mean, you hear about this in the market. If you're buying a $500,000 EBITDA business, you may just be sort of buying a job. And so there is some truth from a risk overlay perspective. A smaller deal is a riskier deal. It just is. If you look at a $5 million EBITDA deal or a $3 million EBITDA deal, there's probably an extra layer of management. Like, let's just use HVAC or pest control, both awesome businesses, as an example. If I buy a $500,000 SDE pest control business, that pest control business might only have 2 or 3 technicians who are going out into the market to generate revenue. If I close on that deal and if I lose one of them, that can have a meaningful impact to my overall business performance. But if I'm operating a $3 or $4 million EBITDA pest control business, I probably have a pretty big bench of technicians who are out in the field. I'm going to be more able to deal with the volatility if I have that deeper team. If I lose somebody, I'm going to probably have better continuity, just as an example. So that's a significant reason why. I think another reason why, though, is as you continue to go up market, I do believe that the amount of capital, particularly institutional capital, that is flowing into the space grows and grows and grows. And I think that the expected return comes down as well. So if you look at what, a decent private equity firm is looking to earn on an equity return perspective, it might be 20-25%. And so consequently, they're willing to pay more. They're willing to pay a higher entry multiple where they're going to be able to hopefully grow that business organically, maybe experience a little bit of multiple expansion between the businesses that they acquire and the businesses that they sell. But that's still going to get them, from a recipe perspective, to that 25% net IRR that their limited partners are sort of looking for. And so consequently, I think the second reason is, as you continue to go up market, I think a lot of institutional capital flows into the space. I think that it's just a more competitive space. All of those deals are often auctions where it's really all about highest price. And so consequently, I think that the competitive nature of the environment as well causes the deal multiples to probably increase at a rate that, in my mind, is probably higher than simply the benefit of having a slightly de-risked business by virtue of the higher amount of cash flow.
This is a question that I get asked often from friends of mine. How do you get comfortable with the SBA personal guarantee? I'm curious how you think about that.
So I have a lot of students who talk to me about this as well, because it's a real thing, and you should really feel like it's a real thing, particularly if you own a house that you could be putting at risk, particularly if you have a young family at home. That PG is real. I guess there are a few thoughts that I have. First, it's interesting to watch the evolution. Again, a lot of this is human behavior. I'll meet a lot of students who take my ETA class, but they're still like relatively early in their journey of trying to figure out if they can get to a high level of conviction to go out and do a small business search. And initially, they'll say, like, I will always bet on myself. Of course, I'll PG the deal. But as they go through their journey, a lot of them end up concluding that they can't, or they don't want to. And I get that. Like, to me, it's a very personal decision. Let's just say it out loud. If you sign a personal guarantee for a small community bank loan and you default, they'll default you. They absolutely will. Now, they might try to work it out with you consensually, which might fall short of you having to file for personal bankruptcy. Sometimes you will have to file for personal bankruptcy. If you own a house and they have a second lien on that house, they absolutely will push you to sell that house, or in some cases foreclose on this house. So the first thing that I tell them is, you should really take that decision seriously, because it's real. And don't think for a second that they're going to say, hey, this is a nice guy in our community, we're not going to try to seek repayment on a portion of our loan. Second, I'll ask the question, and I realize that this may be a little bit inflammatory, but I will ask them, if you're not willing to sign a personal guarantee, does that mean anything in the context of, whether or not going down this path, just buying a small business, is the right path for you? Now, there are other ways to do it. You could raise a traditional search fund. You could go through an accelerator. Usually in both of those situations, there's no personal guarantee. But I will just ask that question too. If you're not comfortable with signing a personal guarantee, it's not dispositive, but you should at least consider whether what you're feeling inside about not signing that personal guarantee, whether that impacts your overall thinking of just buying a small business, because it's hard, it's not easy, it's risky, and you should at least sort of internalize whether your feeling about that PG should be impacting your feeling about doing this as opposed to doing something a little bit more traditional. Yeah. I will, though, say, for a lot of my students who decide, that they want to do a self-funded search and they want to, they're willing to sort of PG the debt. I mean, the right answer is, you can look at the statistics, right? The SBA, publishes their default rates. There's some companies out there which have done some FOIA requests to try to get some additional information. Historically, the default rates for these acquisition loans are relatively low. I don't say that, for people to just look past it and just say I'm all in. But as a general matter, I do believe that there are things that you can do to mitigate the risk of a default. So let's just talk about what those things are. I think, and this I think is actually maybe the most important thing that we're going to talk about because it's just not talked about enough. You should be laser focused on liquidity management and working capital and just having enough cash in the business or on your personal balance sheet to deal with the volatility in the market while you own that business. I mean, we're experiencing this today. Look at the shock, probably from a demand perspective, certainly from a supply perspective, that's happening in the market today. If you buy a business 90% loan to value using an SBA 7A loan, where you've got a personal guarantee, you better be laser focused on making sure that you've got some extra cash in that business, in your bank account, to be able to continue to meet your obligations with your lender, even if you lose a major customer, even if the overall macro market goes through a period of volatility like we're experiencing today. So I will tell folks who have decided that they are comfortable with PGing the debt to not stop there, but to try to figure out and do a series of things to try to mute the likelihood that they're ever going to have a default event. It's not only liquidity management, it's finding a high quality business. And what does that mean? A high quality business, in my mind, has really good recurring or reoccurring business, ideally subscription revenue, right? These are the sorts of businesses where historically, as you're incurring that debt and that PG and underwriting that loan, if you have attributes like that, I believe that you can mitigate quite a bit of the risk of defaulting on the loan during the hold period.
Yeah, we experienced that. The first group of businesses that we bought were fixed wireless businesses. So we provide internet to people's homes. And we were naive. We did poor diligence. We didn't know what we were doing. We didn't have private equity backgrounds. We just came in fully blind. And lucky for us, these businesses were low churn, sub 2%, so no matter kind of what we did or issues that we ran into, people just continued paying their bills every single day because they wanted access to internet. And that gave us kind of the time that we needed to figure things out. So I couldn't agree more on finding a recurring component. Tell me a little bit of,
and just related to that, I mean, the broader point is, I just co-authored a paper, and one of the things that we dug into just in the introduction was all about like the quality of the asset really, really matters. So like we were looking at it from a traditional search perspective. If you have great investors and you're a great operator, but you buy a crummy business, you're probably not going to have a great outcome. And so it really, really is important. It's very important to find a business that has those high quality attributes, usually low capital intensity, good margins, not in a space where there's a lot of disruption. So I think that, that can't be said enough. If you have a lot of confidence in yourself, but you buy a crummy business, you can find yourself in a world of pain. And just like you said, I've seen a lot of examples of folks who just sort of did okay as an operator, but they had a really high quality business and they still were able to get to an outcome perspective that was pretty impressive.
Tell me a little bit about funded ventures. I've heard of kind of different variations of how folks structure these SMB search groups. How are you thinking about it, and how are you approaching the infrastructure and structure of the deals as well?
Yeah. So I started funded in connection with doing that roll up, and I wanted to continue to invest in the space, particularly in self-funded search, and just develop a brand in the space. I really enjoy partnering with people. I like partnering with younger people. I like being a mentor. And I started to teach these classes, and I would have students at the end of the class come up to me and say, you know, I really have a heart for small business. Maybe I'm from a small town in Missouri or Illinois. Maybe my dad worked or my mom worked in a small business growing up. And that's really important, right? I always like to find people who sort of grew up around that entrepreneurial
Because then they
spirit.
know how
And they would
painful
say,
and how late their parents had to stay up some nights. People need to like
yeah,
experience
and they
that
just
firsthand.
understand risk in a way that if you're a mercenary at a law firm, you just
Right.
can't. Like you actually have to make hard decisions all the time. Not hard technical decisions per se, but hard decisions where there's sometimes, not a lot of winners. And so I would have students come up to me and they would say, I like everything that you're talking about here, but like it would make me a lot more confident to go out and do this if I had somebody holding my hand a little bit. And I would introduce them to the accelerators. They might do an internship at one of the accelerators. But in some cases, maybe there wasn't a spot available for them at an accelerator, or maybe they just decided that wasn't the right place. One of the problems with the accelerators is you often, as the first time operator, you still only own 25% of the business. And for a lot of these folks, they want to own more of that business and they're willing to personally guarantee the debt. And so I sort of reflected upon a couple of these conversations and I ultimately decided to get my feet wet with one of my former students. And we put together a deal where for 18 months he could go out and do a full-time search. And I paid him, a few dollars every month. It's not an amount of money that would make him get comfortable just continuing to do his search in perpetuity, but it's enough to make sure that he can continue to put food on the table at home. And then what I agreed was to write an equity check to underwrite the equity portion of his purchase price that's required to enable that SBA 7A loan. And I was very focused on the idea of doing roll-ups. I continue to believe that for someone like me, who is comfortable with complexity and comfortable with doing deals, I always want to capture as many advantages as my partners and I have. And so I really wanted to make sure that from an optionality perspective, the ability to do bolt-ons was a core part of the industries and the assets that we were focused on. So I ended up doing this first with one of my former students. I've now done it a few times over. And he went out into the market. He's now about 15 months into his search. He's made a lot of progress. I think we're really close to finally, getting ready to close on a deal. And we have really partnered day to day in his search. This isn't about just providing him capital. It's not just about cheerleading for him, although I think cheerleading is really, really important. You know, it's about giving him my point of view on a lot of judgmenty decisions. What happens if he feels like he's got a deal in hand with the seller, but like there's just something off where that LOI hasn't gotten signed. Is there somebody else? Is there another interloper on the periphery? We'll sort of game theory that out. I spent a lot of time with him, particularly in the early days, talking about investment theses and what we think is a high quality business or a low quality business, and then even going one level deeper. Okay, we like HVAC. Well, what's a high quality HVAC business and what's a low quality HVAC business? I spent a lot of time early in his process just helping him get networked. I have the luxury and the benefit of having a pretty deep network, and so I reached out to dozens and dozens of people in my network and set up calls with him so he could tell his story and really develop and become very punchy in the story that he was telling, which is of course critically important when he talks to sell side brokers or talks to sellers. But I would also spend a lot of my time really getting him networked in a bunch of these different industries and with a bunch of these intermediaries to really try to create those shortcuts to allow him to start to really rev up the conversations that he was having with sell side brokers and sellers, and also allow him to do a lot of proprietary outreach. He looked at 7,000 deals
Wow.
last year. I mean, obviously he didn't go deep, in a lot of those deals, but there's been a tremendous amount of work and effort, to really take this as a full-time job, probably plus some overtime, and really find that deal that he can buy and then get in the seat and learn how to operate and grow.
And when you do find a business, are you planning on financing it with SBA again?
So the beauty of buying these small businesses, particularly where they have 15-20% EBITDA margins, is they will generate some nice cash flow. Now you can choose to reinvest that in organic growth. You could try to, obviously you'll need a lot of it just to pay for the debt, but you can also start to pool it and use it to form the equity check for your ultimate bolt-on acquisitions. And so our playbook is we're going to get that first deal done using an SBA 7A loan, get in the seat for 6 months, 9 months, really try to grow the business and demonstrate that we can have that operational excellence, because I think that's really important. I think that's actually what's really important for the next 10 years in this market, and then start doing some of the bolt-ons and try to sort of grow that equity account both via the organic growth as well as the M&A. And our hope is, I mean, one of the reasons why I structured all of this the way that I did, I haven't raised any third-party equity capital. I wanted to eliminate as much of the conditionality from these deals as possible. I look at what a lot of my peers do in the market. Some of them are independent sponsors. Some of them might raise a small fund relatively early to go out and do deals. Those are all wonderful models. But for me, I'm still figuring it out. And so until I feel like I've figured it out, going out and raising that third party equity capital or trying to do a bigger deal where it's contingent on passing the hat and raising that third party equity capital, that's very scary to me. I don't want to go back to those equity investors and say, you know what, I pitched you on this strategy. Now I want to do this other strategy. I don't want to, go back to them and say, listen, we learned a really hard lesson. We lost a lot of money, but I feel really good that next time we're going to get it right. I don't want to go out to the market and say, I found this great asset, but I can't afford to buy it. So, imagine doing that right now with all this volatility. That deal would never get done. So what I decided to do, I'm a big fan of go slow to go fast. And so my view is if I can warehouse small things, I believe in the value of small things. So my thesis is if I can partner with these first time operators, and if we can buy small deals, largely using SBA loans for the first one, and if we can come in there and if we can actively grow that business both organically and via M&A, it's going to put us in the best position from an optionality perspective to figure out what comes next. And maybe what comes next is some sort of small pool akin to a fund. Maybe it's passing the hat for those bolt-on acquisitions and really feeling like I'm giving those third-party equity investors something special, because one of the things that I would be giving them would be my first anchor investment, potentially at my original cost. And so I'm really excited that if we can just continue to fight through this first phase, I think what we're going to be able to do is develop a foundation which is really attractive to whatever comes next. And so I want to keep our options a little bit open because I feel like there's a lot we need to learn, but I'm pretty confident that whatever comes next, it's probably going to be bigger than this. It's going to look a little bit different than this, but I can sort of only totally get clarity on that, when we accomplish a little bit more with this first phase.
I can say, as somebody who got a baptism by fire in the world of small business acquisition, I would have really valued having someone as a mentor and coach who had the experience, who also had skin in the game, frankly, had mentors, but they didn't have any skin in the game. So they don't pay attention as
Very nice of
closely.
you to say. I think, it's it's very scary, plunging into the subscale of the market, and you can never be totally ready. You just can't. I mean, maybe if one of your parents bought and built their own small business, maybe it would prepare you certainly better than the preparation I had. It is a balance, though. I mean, to your credit, you dove into the deep end, and I've waited a lot of years. I'm in my mid 40s, and man, I wish I would have sort of started down this path when I was in my early 30s. But I think at the end of the day, as you well know, you know, I interviewed Sandy Page at Babson at their ETA conference about 8 weeks ago. Sandy's very famous for going out and raising his search fund in his late 40s. And what did he do? He built that business and literally like 3 years later sold that business for, it's public, something like $275 million. And so I do believe that even though I'm in my mid 40s, I still have some good years left. There is still a meaningful contribution that I can make into this space. And I think that there's a significant opportunity to work with some younger folks and buy these small businesses and scale them very, very quickly. But, compounding is a very real thing. Buffett's not wrong on that. And, I am sort of envious too for people who sort of figured this all out a little bit younger than me, and they've now been at it, 8 or 10 or 12 years.
Well, Brian, I appreciate you sharing your story. It's certainly a fascinating one, and I'm excited to see what you build with funded ventures. What's a good way for people to either stay in touch or contact you if they want to work together or follow what you're doing?
All right. Yeah, thanks for asking. And thank you. I'm such a huge fan of all of the contributions you've made into the space.
Thank you.
For the benefit of the listeners, you and I did a panel on Holdcos together, and I learned a lot from you. I mean that sincerely. I'm pretty active on LinkedIn. Brian Wolfe, BrianWolf, as in Frank E. Check out funadventures.com. But like you, I'm really excited about this community. For the most part, I found it to be collegial, and I feel like I've been able to learn a lot more, much more quickly, because of the willingness of folks in this community to just share their stories and their experiences. So I welcome anyone listening to this to sort of reach out to me. Would love to sort of stay in touch, and thank you very much for carving out some time today. I've really enjoyed speaking
My
with you.
pleasure, Brian.